Okay, today we're going to go over a quick little overview of flexible spending accounts. Now, we've mentioned these before in some of the previous chapters, so what we want to do now is just kind of touch base on the aspects about flexible spending accounts that we have not heard of yet. So these things are going to be something we want to keep in mind when we're moving forward and looking at like cafeteria plans or other types of combinations of health insurance and healthcare plans that employers could or would offer. All right, so the basic idea here is an FSA. It's really a one sentence explanation. You know, if you had to tell someone like this, would be, hey, it's like an HSA, but you don't generally get to keep the funds. FSAs, similar to HSAs, are offered under usually a cafeteria plan, and most of them are reimbursement after the fact. It's not quite as common, at least at this point in time, to have an FSA on like a debit card as you would an HSA, but they functionally work in very, very similar ways. All right, so the utilization here really depends on what the employer is looking to do. Again, there's never a one size fits all for something like this, but they're best when the employer's medical plans have large deductibles. So again, kind of similar to an HSA. It could be if the co-insurance provisions are not that generous. So if for some reason it's a 60-40 co-insurance. That could be if it's out of network, right? But traditionally speaking, this pairs well with a high deductible healthcare plan. Again, similar to an HSA. If needs are difficult to provide for, if a standard traditional plan or basic medical plan would not cover this, FSAs tend to have a broader range of coverage. It could be that other plans are too expensive. Well, since FSAs are coupled with very high deductible healthcare plans, the premiums tied with those plans are often quite low. There are still, you get tax deferral, right? So just like with HSA or 401k, 403b, 457b, 529c, as you're putting in this money, the election here is that it's deferred. So you put $100 into it, that's $100 that you're no longer taxed on. And just like an HSA, as you use that, it's coming out tax free, so to speak. And then, really, these are not good for smaller and employers. Most smaller employers at this day and age are essentially saying, here, we're going to give you the employee a little bit of money, and you go out and find your own health insurance. That tends to not work quite so well for some of the employees because if they have to go out and find their own health insurance, generally means they need to go on the exchanges, and the plans on the exchanges are significantly worse in almost every way compared to a standard or traditional employer-based plan for the same reasons that we talked about group plans just being a little easier to pool and underwrite. So the pros and cons here. So the pros, all right, well, it's something other than a standard health insurance plan. It's funded through salary reduction. We have some payroll tax deductions for the employer, and then the employee gets that tax burden reduction. So that's all well and good. That's great. Now keep in mind with traditional health insurance, or excuse me, healthcare expenditures, that those are often tax deductible as well. So it's not like you're able to only do this through FSAs or HSAs. But the payments to these accounts are not that way. Okay, meaning that you pay into a FSA or HSA account and it's held pre-tax, right? Whereas if you have a standard traditional plan and you have to be real or you have a medical cost that you pay for, then that's something that's tax deductible ex post. Disadvantages of FSAs. So ERISA comes into play here. It's a little more stringent even than an HSA. Employees have to kind of guess at how much they're going to use because FSA benefits generally do not roll over. The funds almost never roll over. So if you have $1,000 or $2,000 in your FSA at the end of the year, you better use it or you lose it. And that's really the primary distinction between an HSA. And generally speaking, all things constant, if you're advising someone and they can choose between an HSA and an FSA, again, you need to be aware of the granular details, but dollars to donuts, 9 times out of 10, HSA is just going to be a better plan. That doesn't mean that there's no use for FSAs. They're still in the market. If they're still in the market, there's a demand. So some people want them and can utilize them. All right, so how would an employer briefly go about implementing these? So you have to decide what benefits are provided. You have to keep in mind those ERISA requirements too, somewhat stringent. And then we have to let the employees know this. And this is kind of this can be a linchpin, or in a good employee benefits package. You need to let them know what's being offered. You could have a great employees benefits package, but if you're not letting the employees know, then they might not see any value in it, and that could hurt your retention and eventually your bottom line, because you have high turnover because people won't stay with you because they don't know how good your plans are. For employees, they have to elect these salary reductions. I want to take out $100 of my paycheck every week. It goes into the FSA. I'm not taxed on that $100. And if I have medical expenses, I can use those funds, and I'm not taxed on those. I pay straight out of the account. Okay. Um, and then I have to record those, so I have to show. I can't just say, "Hey, I totally had to go to the doctor the other day. Let me get $300 tax free from this account. Thanks, I appreciate it." No, no, you have to show that it's a covered expense. Okay, and then finally, that problem, the primary disadvantage, again comparing these to HSAs, is that any funds in the FSA at the end of the year, if you don't use it, they're gone. Okay. Now, other basic design features. So again, it's a reimbursement plan, so it's kind of ex post is a way to think about it. You do get dependent care reimbursement. Now, this is kind of a pro of FSAs, right? That we talked about earlier. You can also put in adoption assistance. I've never seen this in an FSA, out in the wild, so to speak. But this does happen. There's nothing wrong with it, and it could be a benefit that some people would like. Okay. Now, taxation for employers. So we get to deduct, as an employer, we deduct the amount that we're reimbursing employees. Okay. We can reduce our payroll taxes, and again, we've covered that in other chapters. It's no different really. And then the payroll taxes that can be reduced include Social Security, federal unemployment, state unemployment, and then workers' compensation here. But again, we've kind of hit on that on the employer side already, so nothing really changed here. It's still an expense. It's still seen as a healthcare deduction. Now, for employees, again, we kind of hit on this already. It's pretty straightforward. The contributions are not subject to income tax. However, highly compensated employees may be taxed if the plan is discriminatory. So just like, you can't offer a higher 401k match to your executives or your managers for it to be a qualified 401k, you also can't do the same thing for an FSA and HSA. So, you can't contribute more or only give it to certain employees. No, you have to hit that, just like a retirement account, you have to hit that 70% benchmark with few exceptions. If benefits are for some reason a high enough percentage, so if we're just giving through FSAs, HSAs, and retirement compensation, if that actually comes up to 40 or 50% of your total compensation, it may be that you're taxed on these, right? So there's nothing wrong with someone not wanting to pay taxes. There's nothing wrong with deferrals and credits that follow the law, but true avoidance in the illegal sense is something that we don't want. And if you're the employer or the employee, you need to be mindful of this. Now, when it comes to FSAs, this is not very common because most employers that offer FSAs also have an HSA, and most people just take the HSA for the simple fact that you just get to keep the money. But again, FSAs do have some distinct benefits. Okay, now a couple of frequently asked questions here that I think are going to be important to keep in mind, for you personally, or if you're helping an employer, or if you're advising, someone who's comparing and contrasting their healthcare plans. So first question, is an employee locked in for a full year to their salary reduction, or can it be changed? Usually, you're locked in for the year or whatever the kind of policy period may be. Now, if you have a qualifying life event, and we cover that in the health insurance, the initial health insurance chapter, you can alter it a little bit with very few issues. Okay, but for example, with if I had an FSA, I have an HSA and I utilize it, but say it were an FSA, or it works the same way for the HSA. I've made my elections for deduction for the next enrollment period. So I do that in November, and then in January it starts. And from January to the end of December, then that same, $100, $125, whatever it may be, is taken out of every paycheck. Okay. Every pay period. And then another little question here that you may see, are these salary reductions recognized for state or municipal, so like local taxes? So do I get to circumvent local taxes or city taxes or ordinance anything like that? The gist of this is if they're based on federal taxable income, like most are, then the salary reductions are generally effective for most state tax purposes. California varies at certain brackets, as does New York. So if you're in the upper bracket, I believe this year it's around $348,000. So if you're in California and making more than $340,000, then the dollar over, 340, so that 340, 340,000 and $1, that $1 is taxed, or it is not privy to salary reduction through FSAs, HSAs, and 401ks. I'm not sure exactly if that's something that's really going to come to play because if you're making that much money, that little bit of salary reduction, is not going to be a huge deal for the most part. That doesn't mean it's not something that individuals care about, and then some of your clients may be in that income range. Again, that would put you a little above the 99th percentile, making around 340 or so per year. But you're going to have a broad swath of clients, and some of you may go on and you'll be in these income brackets, so you need to know this for yourself. But for the most part, that's not going to affect many people. Again, less than 1% of people, and that's in California and New York. Okay, but for the most part, you get to defer for all levels of taxation here, not just the federal tax level. Okay.